obviously, we saw what the ECB did yesterday, a 50 basis point hike. Right now, we're looking at the CME FedWatch tool. This morning, it shows an 80% chance of a quarter hike and a 20% chance of no hike. What do you think?
I'm with the 80% camp because the Fed has all the tools to limit the fallout of banks because of the liquidity problems. And therefore, it doesn't have to pause on rate hikes. So what the ECB did yesterday showed a similar way of actually expressing confidence in the banking system, saying we can actually control the situation with liquidity while raising rates.
All right, so I'm just going to talk to you about the other side of this argument. What we're seeing with the banking system, it's going to make loans harder to get. It's going to make loans more expensive. Won't that slow down the economy, which is overall the Fed's real goal with these rate hikes, is just to cool off the economy?
It is, and I think that is the next step here, that as the fallout from Silicon Valley Bank affects the economy, everybody is now understanding that the deposit costs are going to go up, and that's going to be in loan rates and therefore harder to get credit, or at least to an extent. So yes, you could expect more slowdown in credit.
Okay, so after this potential hike, whatever the decision is, do you expect the Fed to say, hey, that's it? Or is there still an opportunity for more hikes in the future?
I think there's still opportunity for more hikes because inflation is just too high. It will take some time to get it down, and this episode will not necessarily cool it off so quickly. So you would expect the Fed to take data-dependent approach, just like the ECB, but then reassess that data and say if there's no more further financial tension, they will resume rate hikes in May again.
Yeah, 6% inflation is a long ways away from 2%, but we got to remember those inflation metrics are actually backwards looking, so something to watch. I also want to circle back to our intro. We talked about the discount window. For all of our retail investors, that's essentially the Fed lending money to banks to help with liquidity. So JP Morgan said banks need a lot of money. What are you seeing when it comes to the discount window, and what is it telling you?
So indeed, the stigma is fading. I would agree with them because you saw actually the discount window being tapped also by banks who need that new window. And I think that's an indication that banks are not worried about getting an additional stigma on them going to the Fed for emergency liquidity. In the end, it's available there and it's something that is needed. So I think this is a good sign and a healthy sign. In the end, it's also about the Fed being able to step up quickly and provide liquidity that way, and therefore expressing confidence in the system. And that then gets channeled back to the markets. So I think that's why markets are up this morning.
Yeah, I think liquidity might be the word of March. I can't ever remember hearing that word more than I have this month. So before we let you go, let's talk about the broader markets. We're seeing futures up this week. We're seeing the markets up for the week. After incredible volatility, a lot of concerns about the stability of the financial sector. What are you expecting for the rest of today?
So there will be still some volatility. I mean, you can tell from the pre-market of seeing Credit Suisse and First Republic under pressure. There's some uncertainty about how this is exactly going to play out. But that the broader market is positive means that we actually didn't really deal with a true systemic issue at this point. We are just simply preparing for next week. Again, a confirmation of the Federal Reserve. If you can raise rates in an environment where liquidity is tighter, it does indicate to markets like there is not a significant problem in the banking system that would lead us to what we experienced in 2008.